We're going to run through the main topic this morning, which is alternative financing strategies. My name is Charles Bond. I'm a corporate finance partner at Gowling WLG. We're an international law firm. I head up the natural resources team, specialise in mining. So I spend a lot of my time working for companies who are trying to find finance. So I'm very familiar on this topic. And in my weekends, I'm also on the board of directors of a small listed copper company here in London. So I'm also equally through that acutely aware of how difficult it is to raise finance. Although we did raise some last week, so I'm quite pleased about that. So we have a great panel here actually representing all the elements of the kind of financing sector this morning. I'm going to let them introduce themselves one by one. I think that's probably easier than me trying to proceed it. So if we go down the line, do you want to start first, John?
Yeah, John Meyer. I'm a partner at SP Angel, which is a small investment bank, or as people used to describe us as brokers before we got labelled as investment bank. But I started off working in a Cornish tin mine many years ago, and worked my way up through project finance and enjoy working as an analyst in the equity markets these days.
Hi everybody, Juan Alvarez. So I work for a private debt fund called Nebari Holdings. We're about 7 years old now, so a pretty young fund. On the third fund, which is a $400 million fund. First two funds have been completely deployed now. And what we do is debt and convertibles to the junior sector. Because it's debt, it's still, the juniors still have to have some capacity to pay us back, but it is the sector which is too small for the banks, etc.
Julian, Vickers, good morning. I'm the chairman of NRG, which is an advisory firm focused on natural resources based here in the UK. I'm a mining geologist originally, spent 7 years in exploration primarily. I was global head of energy investment banking at Citi, and then global co-head of natural resources investment banking at Barclays. And NRG is about 10 years old.
Good morning, everyone. Liam Farley, CEO of Xcelsior Capital. Xcelsior is a mine finance and trading platform partnered up with Wogan Resources, who are a 50-year commodity trader specialising in off-exchange critical metals and minerals. My background is a geologist. I started out in Russia, Australia, with the likes of BHP, etc., before moving on to mostly on the buy side in the mine finance space.
Excellent. Well, so you can see we've got a real range here of financing specialism. But I think I'm going to start, if you look at the companies here today, pretty much, I think there's about 3 or 4 who aren't, but pretty much all of them are listed and in the capital markets. So we know the capital markets are having a tough time, and that goes without saying. But I'm going to go first to John as the broker for SP Angel, and just get your opinion, John, if I may, on the health of the capital markets, whether you think it's turning at all, whether you think certainly the reforms in the UK are going to have any difference, and maybe, if you can, give us a comparison with what may be going on in Australia or Toronto.
Yeah,
Not a small
a lot
question.
of points to answer. Yes, it's been very tough. But we did just ring the bell on an IPO yesterday, although not in the mining space, it was in the technology space. We know London's been tough, as have a lot of other markets around the world. Singapore, France, you name it. Australia's been a bit better, mainly because they had quite a number of acquisitions in gold and lithium in recent times, and that money's been circulating round and round. But when we've compared the liquidity between stocks in London and Australia in the market cap range between 20 million and 200 million pounds, then actually the liquidity levels have been the same, which surprised us, because we thought Australia had been a better market. Canada has been somewhat worse. We knew it was bad in Canada. We hadn't realised how bad the liquidity was. But I think that's because they have so many small companies. And so you're spreading a smaller pool of capital around a much larger number of stocks. Yeah, and as I say, it's been tough. There's not been much capital raising for straight equity for small companies in the small mining companies in the UK. We work with a lot of explorers and companies that are developing projects, but there are a lot of other types of capital out there these days, which you used not to see. I'd say there's still a problem with project finance, but there's much more development finance out there. That's money coming from governments, and we keep finding new pots of that and seeing evidence of it. There's definitely much more royalty finance, streaming finance, offtake finance. There's so many new instruments that people can access. I'm not saying they're all great. I'm very pleased to see that there are no death spiral companies sponsoring this event this year. I guess the market needs a range of instruments. You can't just rely on equity. But the good thing was the Chancellor in her speech last night at Mansion House has announced that they're going to consolidate a lot of the government pension funds. There's an enormous amount of capital in these local authority and different government funds. Those funds have been so small that the trustees have not wanted to take any risk, and they've invested a lot of that capital abroad. I mean, we know that there's been an enormous flight of capital to the US, going into the Magnificent Seven companies, and for good reason, actually. But the government saying, no, look, come on, guys, you need to be investing back in the UK again. This money needs to come back. 4.4% UK funds invested in small cap in the small cap market just isn't enough. We understand that the trustees don't want to take risks, so let's put these funds together into some super funds that are able to manage lower liquidity levels, are able to manage higher risk tolerance.
Yeah, Rachel said, didn't she, said last night to the regulators, you've got to regulate for growth, not regulate for risk, which was quite an interesting concept. But let's see if they put that into action. Certainly the UK markets have seen some reforms to the capital markets here, but I think the jury's still out if that's going to have a significant effect.
We have noticed the regulators have become a bit easier to work with.
Yeah. Julian, I know when you're looking at deals, you look at twin tracking companies, so you're looking at investment or possibly joint venturing. On the capital market side, are you seeing, what's your view on that?
Well, I think I would echo John's point. It's very difficult at the moment. I think one of the problems is that people are in a state of anxiety. That hasn't really gone away. So we see a lot of risk off investing. If you have an infrastructure project, everybody wants to know. If you have a greenfield industrial development project, literally nobody wants to know. So that's difficult. I think the other issue that I would pick up is that there has been a big trend towards putting money into index tracking funds. And if you take that to its logical conclusion, the markets will just seize up. So essentially, money that's notionally earmarked for risk ends up going into the index of large caps, and it doesn't find its way into the real economy that needs that investment. So I think that's an issue. I agree with John on the consolidation point, but I'd just caution that there has been a tremendous amount of consolidation in the asset management industry. So it's become almost cost-led rather than performance-led, right? And until you change that dynamic, it's going to be very difficult to have people look for excess returns, which is fundamentally what you need to get them to invest in the real economy. So, I think, when what we find is that clients, might be looking for $10 or $20 million, right, to de-risk a project towards construction, but a large asset manager just doesn't have the bandwidth to look at something so small, right? So so you end up with this disconnect between the people with the funds and the people who need the funds. So just an anecdote: a lot of funds raised energy transition funds, very large ones of like $1 billion or so, but they want to deploy tickets of 50 to 100 million, right? people developing new technologies for energy transition need 5 or 10, right? So you've got this big disconnect. So I think to answer your question, when we have a client coming in, we generally run a dual track process. So we'll look for finance in the market, but we'll also look for strategic investors, right? And that could be either large shareholders coming in, or it could be joint ventures. And we find that generally gives us a better outcome for the client. And I would just say finally that permitting has emerged recently as the number one risk item for sophisticated investors. So if you've got a mining investor, they'll zero in on how long it's going to take the asset to get permitted, if indeed it will, right? So that's become a really big issue.
Just before we leave the capital markets and go on to other alternative forms of financing, one question I want to ask John is, it is difficult, and people now, and the discussion we had yesterday, there was the discussion between short-term capital and long-term patient capital, and the equity capital markets were seen as very short-termist at the moment, and that was putting people off because people were coming in just to flip, they weren't even bothered about the underlying asset, they just wanted liquidity in the stock. So there is presumably still a role for the capital markets for financing, but I just wanted to double check that you still think that's the case.
I've been working as an equity analyst for about 30 years. It's always been short-term. I don't think that's changed.
Right.
Long-term investors were short-term investors who, for whatever reason, forgot to sell the stock in many cases. I want to make one point that I forgot to make earlier. The UK government's talking about encouraging a lot of investment into private companies. In the UK, and I think it's a legal point, the AIM market, in fact, all markets other than the main board of the London Stock Exchange are considered to be private. So all AIM companies are considered by the UK government to be private companies, despite the fact that we all see them as publicly listed. So when the government says, yes, we're going to put direct X amount of money into private companies, that does include AIM, OFX, whatever. What's that called? There's a different name these days. Aquis. All those other markets are included in that.
Oh, well, that's encouraging. Yeah, and there is a move to actually create more public offer platforms in the UK to try and do some private fundraising. That's kind of tends to be match funding there rather than day-to-day trading. But that would be quite interesting if the LSE, for example, managed to do that. They've got this thing called Pisces. You come across that? It's another platform for private companies to trade shares.
Well, there's quite a lot of new crowdfunding platforms. Yeah. There's an issue here in that there are a lot of quite wealthy private investors. The question is then, are they allowed to self-certify? In which case they all just tick all the boxes and say, yes, I'm good to go. Or do you have to do a lot of verification before you allow them onto the platform? I think the FCA has been requiring more verification, and that's always an issue. Yeah.
Okay, well, let's move on to maybe the debt side of things. For juniors, it's often very difficult to raise debt because you don't really have any security on the asset. But Juan, you actually deal with a lot of these companies with the smaller scale debt. Maybe walk us through how you manage to do the debt financing for them.
Yeah, I mean, if you're providing debt, there's a certain threshold below which you just can't provide finance, right? Because it's bad for the company and it's bad for us. If the company can't pay it back, we end up owning an asset that we don't really want to own anyway. So we tend to focus on companies who are like close to cash flow, DFS minimum, and also we've internally we discuss being very agnostic on commodities, but we keep getting pulled back to the core commodities like copper and gold because they're they're much easier to finance. The markets are much more understandable than lithium and rare earths and etc. And I think you really need to understand the market really well if you're going to put debt into an asset. But I think, 2 points. One is, further to Julian's point on permitting, it just takes so long to permit anything. And one of the reasons why we are doing debt is because we essentially take out that binary risk of permitting. Like by the time we get involved, that permit is either there or very close. If you're investing in things that are earlier stage, which might take, who knows, 10, 12 years, 15 years to permit, like nobody's investment horizon is that long. Like who can wait that long for that sort of catalyst to happen, which is a real problem, right? And I think governments should really do something about that, like in the Western world, about streamlining permitting. The other point is management. So for us, we through kind of some pain, we're starting to really look at management competencies. And before it was something that we looked at but didn't look at too hard. Now it's kind of becoming a primary aspect, because it's really critical that you have the right person in the right job for the right stage of that project. And I don't mean that managements are unintelligent or because these are very intelligent people. But you can have the best exploration geologist in the world, and if they're trying to construct a project, it's just too difficult. And vice versa, you can have the best construction person in the world. You put them in the South American jungle to look for the next big copper thing, and it's just not going to work, right? So good management with the right skill set at the right stage of the project is really, really critical. And I think we have to, as like sophisticated investors, which you have on this panel, I think we can't be kicking our own goals for like over and over. And we got like, I think we actually have to improve how we kind of do these things, because the generalist will kind of look at us and go, well, if they can't get it right, what chance have I got, right?
Can I just come in on that?
Sure.
Yeah. So just on the government side of things, a good example is that there's an asset in Ireland where we do a lot of work called Gary Lawn, which is a redevelopment of the Galmoy mine. That actually was approved by 2 local councils for planning purposes about 4 years ago. But since then, various other government departments have been kicking the can down the road, right? And that's created a lot of problems for other projects. But just recently, I understand that the government, through its Sovereign Wealth Fund, the NTMA, has actually started to become more proactive to unjam these issues. So I think the penny has dropped in some jurisdictions that this is a problem. And I think we should be fair, right, to some governments that they're actually starting to act. So there is some good news here.
I've got a story on this one. There's a company in the States called Polymet. In fact, it's been acquired by Glencore now. At the time of the first Trump administration, or just before Trump got in, the Democrats in Minnesota who'd opposed the project for years and years and years suddenly flipped around and gave them a mining license, right? This is just as Trump came into power. So they didn't want the Republicans to take the credit for permitting this mine. The local, or shall we say nearby native Indian groups then opposed it. There were legal challenges. This project is still not going. It's crazy. They've been permitting it through various successive iterations for at least 15 years now.
Yeah. It seems to be, there are stories in Australia as well and Canada. It seems to be this dichotomy that the almost in emerging markets, it's almost easier to permit than now in the developed nations because the permitting has become so difficult, and yet people don't necessarily want to invest in those emerging markets. Okay, so I thought whilst we're on debt, and because of your previous experience, Juan, we might just talk a little bit about royalties and whether you think those are applicable for junior companies. I've seen a couple for juniors, but it seems to be a little bit rare. But maybe, and the royalty industry historically has been much more kind of Canadian focused. But interestingly, I know you were at Anglo, so it's been here in the UK, but you were one of very few for a long time.
Yeah, I mean, look, royalty companies love writing royalty checks, right? And the earlier stage, the better. But managements, I think, have a bit of an aversion to writing a royalty when they're still, like a junior exploration company selling a 2% NSR for $5 million when they know that if they get it up the development curve, that same 2% NSR could be worth like $60 million. So, and a lot of what I found when I was at Anglo Pacific Group, now at Cora, is that there was a real kind of like management, like early stage management had a fear of writing a royalty because it could make them look stupid, right? They sell this thing for $2 million and later it's worth 60 or whatever. Whereas if you raise equity, nobody's ever going to really sack you for that, right? So the money's there, but it's not necessarily like money that's suitable for that early stage. The later you can hold off writing that royalty, the better, I think.
Okay, so on alternative finance, Liam, I'm going to bring you in now because I know you have a slightly different angle on alternative financing. Maybe explain your connection with trade financing, etc.
Sure. So, building on what Juan said earlier about the critical metal space, and a lot of groups reverting back to quite a crowded space of gold and copper, because everyone understands gold and can look at a share price graph, and obviously copper is always the belle of the ball most of the time. So we set up Xcelsior based with our partner Wogan Resources, who are, as I mentioned earlier, a physical commodity trader with 50 years of off-exchange metal trading. And those markets are opaque, they're challenging, they have very complex value chains. And even in spite of lithium's run over the last couple of years, if you actually look about the complexity of taking a spodumene products from Australia and through to a cell into a Tesla, it's a hugely complex value chain that requires a lot of knowledge and expertise to really underwrite lithium. Then you go into graphite and you go into everything else. And Wogan trade 30 of these commodities from the lithiums all the way through to the hafniums, and everything in between. So we took the view that to invest in that space, you need to understand the market dynamics first. And you need to have a view on the way those are changing and the way to invest in those in a smart way and what becomes a valuable material versus an unvaluable material. And so we Xcelsior invest, first of all, with that knowledge and partnership through Wogan. And I think if you look at those metals, the ones that are often uncorrelated compared to the others, and there are great opportunities. But I think for a generalist investor, we wanted to create Xcelsior as a way for them to work with us and co-invest with us into that space to try and bring capital alongside, in theory, some knowledge on those sectors. Now, what the other side of it is, I think it's important to always have a way beyond just lending money or putting equity in. And for us, the importance of our investments are based around securing the underlying trading opportunity of those metals through Wogan Resources, our partner. So we always think about deploying capital in a way that creates that production, whether it's fairly late stage development, all the way through to production and scale. And we don't just do mining; we also look at recycling opportunities and processing opportunities in general. And I think that's an important way to help garner interest in the sector and try and de-risk some of these very nuanced critical metals and minerals, which become. And I've worked in a few buy-side firms in my time, and we always looked at certain sectors in this space and thought we'd really like to do that. A lot of that makes sense, but we've absolutely no idea about where this stuff goes into 27 different industrial end users and what's changing there, and invariably went back to the core commodities which most of us will invest in. So that's our angle of it, and we think traders continue to play a role, especially in the nearer term production and scaling out assets in this space. But it's more structured trade finance, or it's more debt coming in alongside project financing, maybe subordinated, maybe senior as well. It's really that last tranche of capital that comes in, working capital, and obviously taking material through its value chain and finding an end user and crystallizing the sales for companies. Would
you call it offtake financing, or is it because you're more of a fund, so it's not like you're a trader yourself providing like an offtake facility?
So we purposely split the two apart to enable us to have more flexibility about where we invest and how we invest. So we will do everything from convertible notes, mezzanine pieces, through to even senior loans, term loans, and of course traditional structured trade finance, offtake financing as well, which is, I think, the nearer it gets to production for us, the easier it is to deploy capital. And the nearer the prepayment type structures enable a nice connection with the production flow, which structurally makes a lot of sense. But we acknowledge that there are companies where we might have a very strong view on the commodity and opportunity, where we have to go earlier stage, and therefore we have to be a bit more flexible. But yes, it is essentially offtake or sales and marketing type financing.
Sorry.
So I think we're active in the oil and gas markets as well as mining, and in oil and gas, the banks essentially have been prevented from lending money into the sector, right, with few exceptions. So nowadays, if you want to develop an oil and gas field, probably the first call you're going to make is to BP, right? Who basically are running a bank within their organization. So this is very similar to this paradigm, right, of traders. And we're seeing the traders across the board, right, are being much more active now and much more flexible. To obviously at the larger end, you've got Trafi and Glencore, even looking at asset ownership. But I think this is going to be, if the market follows the same trend, it's going to be a developing theme. Yeah. And one point just on what we were discussing before, that Juan was saying, we're also seeing, and again this is sort of the good news, that royalty firms and streamers are now, there's more of them around, it's more mature, and they're becoming more flexible. So if you write a royalty or stream at an earlier stage, many of them are quite happy to put in a buyback. So that you can take out, for example, half of that, right? Obviously, there's a fairly aggressive return, but when you look at it compared to equity dilution, actually, it's not that crazy. So we're seeing people, other players in the market responding to the dearth of equity, right? I don't think it's a solution on its own, but people are making efforts.
Yeah, it's definitely. I mean, one that I would make is with the deals I've seen where Glencore or Trafi have come in, they'll put that mezzanine finance piece, maybe some offtake, but they'll also, you can twist their arm, they'll put some equity in as well sometimes into the mix, which is quite helpful.
Try not to, but yeah, to get a deal over the line, yes, true.
Yeah. Okay, I'm going to move on to one of the other topics that we discussed here earlier. I think, John, you raised it about governments, basically, and why aren't they helping in this endeavour to get people some money. And I know we have I went to a talk last week where the National Wealth Fund, which was the UK Infrastructure Bank, they've changed their name with the new government. So they had about 22 billion, was given by the last government, and Rachel's just given them another 5 billion. So they've got 27 billion to spend here in the UK, of which I think they've probably spent about 4 or 5 so far. But they are at least taking, I think, an active role in trying to motivate, incentivise other people to come in. So if you take, for example, Cornish Lithium, where they came in as a cornerstone original investor, that is at least kind of shaking the market up a bit. That, and I know there are funds that are, in Europe. So Germany, I think, have a critical minerals fund now, for example. So I guess the question for the panel is: Do you think we're going to be seeing more of that government intervention? Obviously, you've got IRA in the US, but the pressure seems to be coming off that. So we're not quite sure where that one's going. But in Europe and other places, do you think there'll be more government assistance?
Well, we heard on the panel yesterday that NATO are now getting involved
Oh.
with mineral projects, because clearly the concern has got to a level where they're saying, well, nothing's really working here. Western governments haven't had the right mechanisms, and they certainly don't have the expertise for investing in this sector. Yes, they've got funds. There have been a number of initiatives in the UK, the Innovate Fund, and then the other things like EIS investment schemes to help financing. We noticed recently, in fact, the HMRC has become very difficult on allowing mining projects to get EIS status. And hopefully that will change, because when you get a transitional period from one government to another government, departments always seem to get a bit difficult to deal with. And you know, we noticed that particularly in Africa, but now we see a lot of what we've seen in Africa over the years seems to be happening in the UK and the US these days as well. So definitely governments want to encourage this. They just need to know how to do it. And the people managing those pots of money need to know how to do it. And yes, there are some new pots of money being created. And I think this new initiative with the Chancellor consolidating some funds, well, certainly they want that to work. Let's hope that opens the market for equity fundraising again, because that's where it's needed.
Yeah, I think government support is absolutely critical for like, you know, critical metals. I mean, unfortunately, the West has kind of stood back and let China take a very dominant position in all of, you know, like things like, you know, high purity magnesium, rare earths, etc. And we're so far behind the curve. And, you know, like from my perspective in debt, back to that, you know, like, and Liam's point about understanding that market, if China has such a dominant position in a market, that's very difficult for us to invest in, because, you know, we just don't know what can happen to that market in the, you know, the short term. So, like, I think the Western world really, like, governments have to start stepping up and, you know, figuring out our mechanisms. As John says, we haven't figured that out yet, but you know, like it just has to have support.
I mean, you have some sophistication. For example, in Canada, they have flow through, right? Which is, I don't know if there's any other country that has that sort of mechanism, but that's quite a sophisticated process, and a lot of companies raise money through flow through, right? Julian, sorry, you were going to say something.
I think that flow-through has been a game changer in Canada. I mean, you can get exploration rebates in other countries, but that's to the company. I think a tax incentive to the resale investor would be very useful, probably everywhere for risk investing. We seem to be going the opposite, but that's definitely the case. On the government funds, yes, I think there will have to be an increasing dedication of capital into the space. I think the detail is going to be important, right? Because that capital ideally should be coming into the assets earlier than permitted status. Right? There's always a tendency to invest in permitted projects, but that's not where the capital is needed. There's plenty of people who do that. So a bit earlier. And then I think in terms of a blueprint for doing it right, I come back to Ireland again, where the NTMA has appointed a lionhead to manage their fund. Okay. Right, so you've got like proper people who understand the industry doing that.
Liam, please.
Yeah, I mean, we've been looking at this quite a lot, because for us, you know, we're not always the full capital piece. We're a part of that solution. So, and a lot of these risks are still a risk for us if it's before production. So I think there are pools of capital out there. I mean, as an interesting point, I was down in Spain last week at the Tungsten annual conference, and I think there was probably 4 or 5 upstream tungsten companies there that are all applied for DPA3 funding from the US government. And essentially their future depends on that financing in many ways. Without that, it's hard to see tungsten prices where they are today and the dynamics, which I think could be easily changing over the next few years. But it requires the US government to get behind these companies, I think, for people to get excited from it as an equity story and to bring them up the development curve to a point where they will actually get developed. And I think that is a critical part of it. You know, we look at Australia quite a lot, and I think you are seeing NAIF and the Critical Metals Fund in Australia doing more. I think a lot of that is around taking first loss on project financing pieces and helping banks then step in and the syndicate to actually come in for the rest of it. Now, that's a bit skewed against the taxpayer of the country, but inevitably it's incentivizing future growth, future jobs, future opportunities. And again, it helps people take risk on the equity side. I think it's really important. But just as important in that, I really think that, to your point, Julian, is that these government help support, the money is important, but it's just as important to help them get projects moving. And the two together is a very powerful story. Without one or the other, it's less powerful. You know, there is money in the US specifically for development, pre-permitting, because they acknowledge that. But, you know, it's obviously hard to get. But that's a really important part of it. So governments need to pay that dual strategy funding, but also support to get projects actually permitted.
Can I just add one more point?
Yeah.
You know, funding is important, obviously, but human capital is also really important. I think we're quite good at bringing, you know, rocks from in the ground to a concentrate. Not so good at getting them from the concentrate to the refined metal. I think we don't have the expertise to be able to build those refining, you know, infrastructure and run them, and etc. And so we also need to invest in like the expertise and the people.
Yeah. Let me give you an example, because examples are always useful. Sierra Resources has an enormous graphite mine in Mozambique. It's currently on care and maintenance because the Chinese have stopped buying their graphite. So they saw this coming. They decided to build their own refinery in the United States. They got it financed. In fact, they've just got $150 million off the US government. They've been building this refinery for a while. All the expertise in graphite processing is in China, or most of it. So they order all the equipment from China. As part of that package, the Chinese are going to assemble it all. But the problem is the US government won't let any of the Chinese technicians into the country to put the plant together. So from what I hear, the American guys, they get a hold of the YouTube videos, they try and see how to put this together. It's still not working.
It's like IKEA, is it?
Yeah, unfortunately, it's slightly more complex. So they're still watching the YouTube videos. It still isn't working. I rest my case.
Yeah, we talked about governments getting involved, but is there any view on what Mr. Trump's going to be doing? Is he going to be accelerating government activity into the mining sector or the midstream? Is he going to be continuing the Inflation Reduction Act, flows of capital that might trickle down to mining? What's the view there?
Can you take us on that?
You might want to rephrase that. What's Elon Musk going to do? And we know that Elon Musk has been encouraging companies. So Elon backed Piedmont Lithium, which then backed Atlantic Lithium, for example. Now, the Atlantic Lithium project is still waiting for its final mining permit from the Ghanaian government, which very conveniently has just broken up and won't get back together again until January or December. But every country has its processes. Elon runs Tesla, so he understands how important it is to get these supply chains going. I feel that more money will come as a result.
Yeah, I think the answer is yes. I mean, the US government has actually been quite active in critical minerals for about 4 or 5 years already, looking at things like building refineries in the US. So a lot of those initiatives haven't yet come to fruition, but given the direction of travel on tariffs and things like that, I think you can expect that there's going to be more assistance from under the Trump administration.
And just a comment that I read, but a lot of the IRA funding has gone into Republican states and jurisdictions. So to pull that funding out would actually impact a lot of Republican voters. So one would think maybe that at least those will continue. And so maybe it's more rhetoric than practicality, but let's hope so.
So here's another story. Tesla, when they first started selling cars en masse, they recognized that getting hold of the rare earths was going to be a risk. So they actually designed motors that didn't use rare earths in the magnets. The problem was those cars didn't travel so far and they just weren't so efficient because they didn't have the rare earths. They very quickly switched to using permanent magnet motors with Chinese rare earths in them. Or maybe they managed to get some from the US, but these days we know it's very difficult to source rare earths. So again, Musk really understands the issue there. They'd all love to get away from using rare earths and permanent magnets, but you sacrifice so much in terms of performance that you just can't afford to do it because the Chinese technology is right up there these days. So they know what the challenge is.
Okay, well, I'm going to leave it there, I think. Thank you, everyone, for coming on. Thank you especially to our panellists for your time today.
Thank you.